So for this year, I mean, I'm bullish on Bitcoin, gold, energy. That's kind of the big areas of focus for me at this time. Bitcoin's already had a lot of powerful price action, obviously, earlier this year. So I think now it's consolidating a little bit. But over this year and next year, I'm bullish on all those assets that I mentioned. And of course, it depends on what their capital mandate is. So, energy is cheap and profitable and has good balance sheets generally. Gold and Bitcoin are kind of alternatives to treasury bonds or alternatives to tech stocks, for example. They can fit in a portfolio in that context. And so those are kind of the assets that I find attractive at the current time. So I think that large cap growth equities have valuation concerns. So, for example, large profitable tech companies, even companies like Costco, for example, they're very highly priced relative to their fundamentals, relative to their growth. Basically, it's not a problem necessarily with the companies themselves. I mean, Costco is doing amazing. It's just that investors are really crowded and really kind of piling into them. So, I do have valuation concerns for those. I don't really have valuation concerns for energy for certain ends of the value spectrum for some of these smaller companies, nor do I have valuation concerns for gold and Bitcoin. Instead, it's just a matter of that sometimes they can get euphorically overbought in the intermediate sense. So that's something I look out for. But other than that, I think that those areas are still not very crowded in terms of overall investor portfolio positioning. So I think you have to be sector specific. I think that's been the challenge. So over the past, call it 18 months, we've had a PMI, a Purchasing Managers Index below 50 for like a year and a half. And so that's already been recession-like conditions for certain industries.
In a recent analysis by Lyn Alden, a prominent figure in finance, data reveals intriguing insights into potential market shifts. With a PMI below 50 for over a year and a half, certain industries are facing recession-like conditions, while others show signs of recovery. Alden advocates for a strategic approach, highlighting opportunities in energy and select financial sectors. Amidst concerns over valuation in tech giants like Apple and Tesla, Alden suggests a shift towards overlooked sectors with robust fundamentals and attractive risk-reward profiles.
And of course, commercial real estate's been in a depression-like context, whereas some of the more service-oriented businesses out there, tech, there's other areas that have been in recovery mode. And so I think that some of that could rotate in the sense that some of the things that have been doing really, really well could increasingly show some weakness ahead, whereas some of the things that have already gone through that down cycle, and if anything, I think some of them are recovering. I expect probably higher PMIs by the end of this year than we started the year at. And I think some of those more cyclical things could follow that. So I think that question of slowdown versus not slowdown is very sector specific. I think instead it's more of a rotation, a reacceleration, some of those things, even as some of those bigger tech things, do slow down. So I do, but I think that even some of the action we've seen is indicative of not super bullish sentiment. People don't pile into Costco at 50 times earnings necessarily purely out of bullishness. Some of that is because it's actually a form of defensiveness. It's saying, I don't really want to own bonds per se. I want to buy a really blue chip company and I'll crowd into that rather than owning any of the things that are more cyclical, the energy names, the banks. That's the capital flight out of there, I think, has been indicative of risk off behavior. And so I don't view that the current period we've been in as super risk on. And instead, it's more indicative of fiscal dominance, indicative of how many other areas are perceived as non-investable. And I think what we could see is a broadening out of what is perceived as investable, right? So some of the risk sentiment could actually increase for some of the things that have been considered too risky, whereas some of those things that people crowded into, I think people could get quite concerned with the level of valuation there relative to the growth numbers that are coming in. If you've seen, for example, Apple and Tesla just not putting up amazing numbers, and the problem is that investors had overpaid for relatively spectacular results that they're not getting in the fundamental data. So I generally like industrials, I like energy. Energy, I think, is the more attractive risk reward. And I think with financials, as long as you kind of avoid the commercial real estate concentration, I think most of that is decent at the current time. I think those are. I think even like, for example, the midstream energy sector, for example, that's been showing signs of breaking out. It's kind of new post-pandemic highs, let's call it, and they pay you very high yields while you own them as well. And so I think that there are a bunch of investable areas, and that the market has largely not wanted to touch those, and that those are, even at the current time, presenting opportunity. Now, when you get kind of overall risk off sentiment, bad days, you can get capital pulling out of those as well. But basically, by being cheap and having good fundamentals, they somewhat limit the downside, and then they pay to own them. So even if the upside takes longer to come to fruition, it's still a positive carry asset for many of these while you own it.
Continuing the discussion, Lyn Alden predicts further turbulence and losses, particularly for lenders heavily exposed to commercial real estate. Despite widespread acknowledgement of the sector's struggles, Alden contrasts the potential losses with the broader economic landscape, highlighting the resilience fueled by substantial fiscal stimuli. This divergence in outlook underscores the importance of strategic investment choices, with Alden advocating for a cautious approach towards over-owned assets and a shift towards undervalued sectors.
Well, so I think that if someone is a professional commercial real estate investor, I think that there are going to be opportunities, right? Obviously going to be bargain hunting, like super cheap opportunities. But in general, I think we're seeing just an ongoing slow motion train wreck in commercial real estate. I think there are more losses coming. I think that lenders that are heavily exposed to commercial real estate are likely to continue having problem. I would say a lot of that's already priced in. A lot of that, a lot of those things are already super cheap. Capital, it's a very well known theme at this point that commercial real estate's in trouble. And I think that a theme I've been making is that so many people keep saying that commercial real estate is going to drive the next recession, whereas what I've been pointing out is even the bearish assumptions are looking at, say, like 1.5 trillion in equity wiped out of commercial real estate. Whereas if you look at fiscal deficits, they're over 1.5 trillion per year. And overall household net worth is something like what, like 140 trillion and rising at all-time highs, right? So there are these pockets that can do really badly, and that, if you're exposed to a bank that has a disproportionate amount of lending to commercial real estate, for example, there still could be more shoes to drop there. But that if you're in areas that are not really in that area, if you're in energy, if you're in other types of finance, if you're in other assets in general, even certain emerging markets, those can I think continue to reaccelerate out of their kind of pandemic lows, while these other things continue to suffer because we're in this environment of kind of structural fiscal dominance. It's very hard to have a recession when you're pre-stimulating to the tune of 1.5 or $2 trillion a year in fiscal deficits. And it doesn't mean that's not necessarily a good thing. But it's a different reality on the ground. A lot of it is kind of like an emerging market where you have to separate nominal expectations from real expectations because you have that underlying kind of fiscal unsustainable backdrop. And that just changes what investments make sense in a nominal sense. I'm not, the answer is I'm not sure, but I would say that I would expect some rotation, which is to say that to the extent that I want to protect myself from that risk, I would not want to own the over-owned things, or at least I would not want to be overweight the things that other people are overweight. I would either want to avoid them or downweight them compared to other things that people have already written off that people are not crowded into, because even if we do get that correction, I'm not sure that it would impact those other assets I'm referring to. So I'm neutral on those. I do eventually expect to see a curve steepening either because the front end's cut or because the long end rises a little bit or a mix of both. And so the overall risk reward of the long end is still not super attractive to me. To the extent that I like bonds, I either like T-bills or I like intermediate term tips. For example, I don't particularly like the long duration bonds, which is not to say that I don't think that they will, it's not that even if they squeak out gains for the year, for example, there are much better other assets that I'd prefer to own from a risk reward standpoint. I prefer to own things that I view as asymmetric, meaning that the downside is relatively contained, whereas the upside has a lot of room to go. And I don't view the bond market in that situation. I wouldn't be surprised if we see yields higher or lower by the end of this year, but it doesn't feel like it's weighted toward a kind of a strong, long outcome. So it's just an area that I kind of put into the too hard pile and say that it's not a lot of opportunity for the amount of risk I take on.
Today's discussion with Lyn Alden has provided invaluable insights into the current market landscape. Alden's bullish stance on Bitcoin, gold, and energy underscores potential opportunities amidst shifting economic tides. His cautionary outlook on overvalued assets like large-cap tech companies prompts strategic re-evaluation of investment portfolios. Moreover, Alden's analysis highlights the nuanced, sector-specific dynamics, emphasizing the importance of astute investment decisions. As we navigate through these market complexities, remember to subscribe to our channel for more expert insights like this video, and share your thoughts in the comments below.